Welcome to a video that I like to call the deep dive video. And I feel for new people that I need to explain this. This is a little bit different than what you might think when you first saw the thumbnail for this video. Every week I do a number of videos. I do a video each day. I do a video each week. I do an intermarket analysis video. And then at the end of the week, the last video that I do is I go through all of the daily charts and I look at those to say, okay, I didn't talk about this chart, but maybe it's still giving us some good information anyway, because we might miss something along the way that can help us to evaluate where the market is at right now. And there are also some charts that I only include in this video. So taking those together, hopefully this will be a helpful video to you. This is being prepared for Monday, December 18th. The first chart is a chart of the VIX. This is a fear gauge. When the VIX is high, it's time to buy. That means there's a lot of fear in the market, even though it won't feel like it. When the VIX is low, it's time to go, even though it won't feel like it because you think the market's going to go up and up and up to the moon. Well, this is another way of being able to look at the VIX, because typically with the VIX, we use static numbers. When we get down to the 12 level, that means there's no fear in the market. When we get to a really high level at about 20, that means there's a lot of fear in the market. But the VIX doesn't always stick within those nice little static numbers. Sometimes it's more dynamic. So what I did is I have the VIX here on the chart, but then I put a 50-period moving average on top of that just to get an idea of the overall range. And this goes back to 2004. You can see that there are times when we go well above the 20 level, and then there are other times when we drop down and make a lower level. And then after the COVID plunge, we made a higher level again. And then now we're possibly in the process of making a lower level as the VIX continues to decline. We don't use this to make decisions. This is more informational. We just like to look at this and have an idea in a bigger picture sense of what is happening with the VIX. Another way that we look at the VIX is how fast is it moving? And I do that by putting an RSI 9-period indicator on here. Now the VIX moves in the opposite direction of the market. So when the VIX is going down, that means stocks are going up and vice versa. And we can use this like an extreme positive or negative reading. We're not getting any kind of an extreme reading right now after we did get one back in November. But now we can see that, remember, you have to flip this over. We're a bit positive here because we're below this midpoint, and it has been coming up just slightly and not giving us an extreme reading. Then another way that we can look at the VIX is we take a correlation between the VIX itself and the S&P 500, because there are some times when the VIX really isn't telling us all that much, and there's a lot of different fear gauges that we look at. Well, right now, this one isn't really telling us all that much. When we spike up above this dashed line, that means something weird is really happening. Right now, we're down in a more contained area. So this chart really isn't helping us all that much. Then we also look at the MOVE index, which measures the volatility of bonds. That's on top. And then we compare that with the VIX, which measures the volatility of stocks. And then down in the other area, I have the S&P 500 in red. And then the green line is the spread between the VIX, and I subtract the MOVE index just to get an idea of what direction is this moving overall. What I pay attention to the most is on the bottom, and this is the correlation. And they have a fairly strong tendency to go in the same direction at the same time. So if volatility in bonds is going up, it's probably going up for stocks, and vice versa. Then we want to keep an eye on where are we when we compare where we're at right now to the all-time high that was set in early January 2022. That's over here on the left. And we're now down 2.06% according to my measurement. Now, this is an intraday measurement. Other things that you look at may say that, oh, we're 1.5% away, or we're getting quite close. This is the intraday high that was set on January 22nd, and then compared to the close over here on the right, where we ended up in Friday's session. Then we also have another thing called technical alerts. And for this video, I just kind of look at all of these together to see what color are we seeing most. If we're seeing red, it's negative. If we're seeing blue or green, that tends to be positive. And we had a really solid up day, and we had a really solid up week. And so we're seeing a lot of blue right here. These are put out by stockcharts.com. And they not only look at the S&P, they look at other sectors, they look at other indexes, We also look at other markets. Then stockcharts.com also has this unemotional way of scoring a chart, and this can be an individual stock, but I use them for indexes. 0 being the lowest and 100 being the highest. The higher the score, the better that chart is looking on a technical analysis basis. And coming in first place, which has been in first place for most of 2023, are the QQQs, which represents the NASDAQ 100, and it's coming in at 88. Now, we're seeing a little bit of difference here, because usually for a long time, we've been seeing the S&P 500 in second place. Now we're seeing the diamonds, which is the ETF for the Dow Jones Industrial Average. It's coming in at 85.4. And believe it or not, we really saw small caps really pick up this past week. If you think about it, if you've been watching these videos for very long, just back in November, we were down in the teens with the rating that this score was coming up with. Now we're coming up to 83.2, and we're actually in third place. Then the mid caps, which also had been well under 30 into the 20 range there for a while, now are really showing some improvement too at 77.5. And in last place, believe it or not, is the S&P 500, which has been in second place for most of the year. It's coming in at 71.7. Now, what's going on here when we look at these other indexes is a thing called the January effect. There's this idea, and historically this has happened, where in December, typically about the middle part of December, and then going into the beginning of the year, we will see some strength in small caps. Now, that's been happening already. We don't know if it's going to continue to happen, but at least it's been happening up to this point. And we're seeing a lot of money going into small caps and mid caps, where the mega caps are still holding up okay, and they've been the real strong areas in 2023, but they've been kind of taking a back seat now, as it looks like maybe the small and mid caps are doing a little bit better. We'll have to see if that can continue, and that's a big caveat right there. Then we look at some short-term charts. This is a rainbow, and I look at all of this together. I try to take the big picture look here. This is a bunch of moving averages that are plotted on the S&P 500, going from 10 periods up to 50 periods, and I changed the color so it looks kind of cool. And we're well above all of the moving averages here and going up higher. So this is just pretty much confirming what we already know, that the S&P is looking quite positive. Over here in about the second third of the chart or so, 2/3 of the way over, this is the all-time high. And we're wondering if we're going to be able to come back and at least give that a test. We also do some moving average studies. This is based on 20 periods, and this is a little different way to calculate moving averages. We do a double and a triple exponential moving average, and that creates a green line and a blue line. And when the green line is above the blue line, that means we're going up pretty solid, pretty fast, and prices continuing to go up, and we're not really deviating away from this moving average. So I really haven't been showing that. Here's a regular 20-period moving average study, both based on a simple moving average. That's where all 20 periods are counted the same. They have the same weight. Where you have an exponential moving average, which puts more weight towards more recent prices. And we're well above both of the plotted moving averages that we have here. And we're also seeing where the red line is starting to come back above the blue line. That's just showing right now anyway that the simple moving average is actually outperforming. That's because we were chopping sideways for a while. It would turn a little bit more positive if we saw the blue line come back and cross back above the red line, because the exponential moving average moves quicker. Some intermediate term charts. Here's another rainbow going from 10 periods up to 50 periods. We're well above all of the plotted moving averages here and looking quite positive. Here's the chart of the S&P 500, and then we go back to the all-time high and measure an anchored moving average, and we're well above that right now. So I haven't been showing this chart. We did come down and test this level when we were going lower back in October, but we've been able to bounce up off of that. Then this is another momentum oscillators where we look for overbought and oversold indications. This is called the Connors RSI, which is very similar to a regular RSI if you're familiar with that. And this one is pretty spastic on a day in and day out basis, but we don't get a lot of extreme positive or negative readings. We did have an extreme positive reading not so long ago, but now we've dropped back down. When we get extreme positive, that means we're overbought. When we get extreme negative, that means we're oversold. When we're above the midpoint, we tend to be more positive, even though this has been declining lately. Then we have another double and triple exponential moving average study. The first one was based on 20 periods. This one is based on 50 periods, and pretty much the same thing applies here. We're seeing the red line above the blue line and prices above both moving averages and going higher. So that's just confirming the upward trend. Then here's a 50-period moving average study where we're seeing the green, sorry, I do know my colors. The blue line is above the red line, and we're going up here. And the red line and the blue line are going higher as well, so that's more positive. And here's a 100-period moving average, and we're getting a bit of ways away from that now. But something more positive could be developing. We're seeing the red line, which is the exponential moving average. It could be getting ready to cross above the green line, which is a simple moving average, and that would just confirm that things are still more positive. Then we want to know, are we above or below the 200-day simple moving average? We're green and above it and doing quite well after having some problems in October. Here is standard deviation. This doesn't measure which direction a stock or an index is going. This measures how fast it is going. And when we were going sideways, we saw standard deviation really dropping off. Now we're starting to pick up as the S&P has been going up, and we're seeing standard deviation starting to pick up. We look for more extreme readings, especially to the upside. That means that we may have gone up a little too far, too fast. Here's the Copic curve, and in the next day or so, I probably will include this in the daily video. We're just about getting ready for the black line to cross above the red line. That would be a buy signal, and this is also a momentum oscillator, and this would turn things back more positive. The Pring bottom fisher, since we're going up, this is going down right now. This is a fairly good indicator for determining when we're going down, 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 and possibly hitting some kind of a bottom. Well, since we've been going up, this indicator has been pretty much irrelevant. Then we look at the S&P 100 on the top, and we compare that with the S&P 100, and we're actually seeing a little bit of an underperformance here. Back earlier in the year, we saw the S&P 100 starting to break out while the S&P 500 was going sideways. Now we're seeing kind of a reverse of that, where the S&P is doing okay, but the bigger stocks in the S&P 500, which ends up being the S&P 100, they're lagging a little bit. And if you watch the intermarket analysis video, I show where that ratio has really been going down lately. So we want to keep an eye on this one. And then this is just some different measurements, and these are approximate because I draw these lines on here. We have the all-time high. You can see the H over here on the left. And then when we supposedly hit the low, it looks like that was the low in October of 2022. And then the bounce up, and then we hit another high back in July of 2023. And then we started to run into some problems. We hit a low, and then now we've been coming back up. And according to this measurement, we're up 13.1% from that intraday low that we hit back in October. There's other measurements that might look at this a little bit different. This is just an approximation. Then we look at a 50-day cycle, and sometimes this is useful, sometimes it's useless. It's worked out pretty well over the last year, but now we're changing environments a little bit now. There's actually the talk of the Fed getting ready to cut interest rates somewhere in the future instead of being more hawkish where they're raising interest rates. Well, while we were in this more difficult or hawkish environment, the 50-day cycle seemed to be okay, seemed to kind of help us sometimes. We don't know if that's going to continue on. Sometimes this marks a top, sometimes a bottom, sometimes just a continuation of what was already going on. The next cycle turn date here is on January 1st, but the market is closed, so it'll probably be on the 2nd or whatever the first trading day of 2024 will be. Then we look at a point and figure chart. This measures just price movement. It does not take time into account. When we have X's, that means we're going up. When we have O's, they're going down. Even though we went up, we did see some X's earlier in the week, but after Friday's session, no new X's were drawn. That was a real yawner of a day. And the last signal that was generated was on November 20th, where we have a double top breakout. And that's pretty much what's happening right now. And this is overall positive as we're seeing the general trend of the X's going higher. Then we look at the mass index, and this is not generating a signal right now. When we get up to this red dashed line and the blue line, that's when we start to pay attention to this, and we're far away. A long-term chart is another rainbow going from 50 periods up to 100 periods. We're well above all of the plotted moving averages here, and we're starting to see the lines really begin to turn and go back up. And if we can stay above this, these will continue to go up and flatten out and get more straight like you saw back in 2021, where things were tending to be more positive. Then we have the daily special K chart here, and this is a long-term oscillator. We don't get a lot of signals from this. If you notice back at the beginning of 2022, when we started to run into problems, we crossed back down below this, giving a sell signal. We tried to cross back above in earlier in the year in 2023. That was a bit of a fake out, and then we did cross back in June, and then we saw a pretty solid summer. Then we ran into some problems and we dropped below the red line. We're crossing back above it now, and we continue to be above this red line. Since we don't get very many signals on this chart, I don't show this chart in every daily video. Then we have an arithmetic scale. This is not a log scale. There's a couple of different ways that you can plot price on charts. And this is just a trend line going back to 2009 and showing that we're getting quite far above that. Since we are quite a ways away from that, I haven't been showing this. Then we look at a weekly chart of the S&P on top. We have a weekly chart of the German DAX right in the middle. And there's a pretty strong correlation between the two right now, at least on a longer term basis. Then we look at the 10-year yield and we subtract the German 10-year yield, and that gives us a line that we see on top. When we're above this red line, that means that US rates are higher than German rates. And what's interesting about this is sometimes we can plot the US dollar index down in the lower area, and then there can be times when there's a pretty strong correlation between the two. We're starting to see them deviate right now, where we're going back up here with this top calculation, and we're going down with the US dollar index. And so we're seeing the correlation not be as strong as it has been recently. Then we have some different support and resistance. This is a chart that I was really relying heavily on earlier in 2023. It's pretty much irrelevant now. We're above this red line here, and we were coming back down, and it looked like we might use this as support. We didn't quite get down to this level. Now we've been going back up, and we're far away from it, so I haven't been showing the chart. And then I measured from the COVID low up to the all-time high, and then break these down into 25% chunks. We're above the 75%, and we're not quite back up to the 100% yet, so there hasn't been a real reason to show this chart. Also, I do a lot of Fibonacci studies, and this is a short-term fib chart, and we've retraced all of this now, so this chart is pretty much irrelevant. And then we take a longer-term fib retracement level study, and we're in no man's land now. We're above the 61.8% retracement level, and we have not gone back up to the 100% at least yet. Here's a longer-term look at some fib levels, also continuing to be in no man's land. Then the NASDAQ, we're above the 61.8% retracement level. We were watching this not too long ago to see if we were going to fall and have this provide support. Well, now we've been breaking out above that. Then this is an indicator of the open, high, low, and close, and taking a 20-period simple moving average. This creates another mini rainbow, and this is going up, which naturally is positive. If we start to see some retracement and start to pull back down, one of these lines may end up acting as support. Then we have an Ichimoku cloud, another support and resistance study. We're above the red cloud, and we're turning into a green cloud, and this is going up. And since we're far away from this, I haven't been showing this chart. Then here's a NASDAQ 100 Fibonacci retracement, and we're getting really close to being back on an intraday basis to the all-time high. We've closed at a new all-time high for the NASDAQ 100, but we haven't necessarily hit a new intraday all-time high. The financial sector is seeing a lot of improvement lately, where we were watching this support level, and this held up multiple times, and we've been able to bounce up off of that. Some broad market measures. This is the VIXN, which is the VIX for the NASDAQ 100. There's a lot of crazy data up here in the middle chart, so I mainly follow the line chart, showing right now that there's not a lot of fear in the NASDAQ 100. This is looking at TIPS, which are Treasury inflation protected securities. When we're in a rising interest rate environment, that's what people want to own. When we top out with interest rates and start to come down, folks want to get into longer term bonds. And so we see this ratio really continuing to go down. It spiked back up lately, but overall it has been declining. We can also look at TIPS and look at further out bonds, and we are seeing a pretty strong continuation down here as folks are not getting into the TIPS. They're deciding to get into the longer term bonds. When that happens, we see this ratio going down. Some rate of change charts just for information. We take Friday's close and then look back 250 periods. We are showing some improvement with this chart. This goes back to 1980, also showing some improvement over here. keeping an eye on some different bond studies where the red line is the S&P 500. The blue line is the long-term bond ETF. That's the 30-year bond. And then we look at the correlation between the two down in the next window, and they have a pretty strong correlated relationship. Even shorter term, based on 10 periods, they have a fairly strong correlated relationship. And then down below, I just have a couple of different ways of measuring the spread between the two. We look at a ratio between the QQQs, which is the NASDAQ 100, and the long-term bond, which is TLT, and they're having a pretty strong correlated relationship right now as well. Then we keep an eye on the yield curves, and the most important ones are still inverted. That's the 10 to the 2-year and the 10 to the 3-month. You can see they're under the red line here, where the other two yield curves that I plot, they're looking more normal now, and they're not as important. We want to keep an eye on this and see if these are going to go back to being more regular at some point in the future. Then we look at a 1 to 3-year Treasury bond ETF and compare that with further out, looking 3 to 7 years. When this is going down, that just means that there's more of a shift back to the idea that we're going to head into a lower interest rate environment. And that's continuing to really drop off, especially if we did see a Fed pivot this past week. That's shifting the whole environment of the stock market, and the market really likes that. And that if that continues, this ratio will continue to decline. Here's another look in an inverse of that same study. When this is going up, that means that folks are preferring further out bonds rather than shorter term bonds because they want to lock in a higher yield. And they're afraid that if they don't do that, interest rates are going to fall and they're going to leave this higher rate out there. So they're buying them now. And when that happens, this ratio really goes up. Then we keep an eye on the 3-month yield. We're back looking at this at 2007, where we topped out, and then right after that was the great financial crisis. Well, we went above this earlier in the year, and we're starting to come back down now. We don't know, is this relevant? Is it irrelevant? It is starting to come back down. Is this giving us some kind of a warning sign? We're not quite sure about that yet, but we just want to keep an eye on this chart. Then I have a number of different charts that I include as a thing called the possible positive scenarios. When we're really going down and it looks like we're bottoming out in the market, these charts can be very helpful. Well, they can also be helpful no matter what the environment is. I still include them as possible positive scenarios, but we look at them. I haven't shown this a lot lately, this chart and the chart right after this, because growth has not really been outperforming value recently. That's a little bit of a concern that we're seeing. Where the QQQs, yeah, they're above the moving average when compared to the S&P, but we want to see this really going up stronger than it has been. We're seeing a little bit of an improvement here with discretionary to the S&P, where it had been chopping sideways. But when we look at large cap growth to large cap value, we're actually underneath the moving average. Then we do some growth to value ratios with the large caps, which are back just about at their moving average, showing a little bit of an improvement with the mid caps, and we're still underneath the moving average with the small caps. Then we look at the percent of stocks in the S&P 500 and where are they in relation to their 200-day simple moving average. We can use this like an oscillator to get an extreme positive or negative reading. Right now, when we're above the midpoint and going up, we're more positive and we're not getting an extreme reading right now. Then we look at that same principle, but based on a 50-period moving average. This is for the S&P, and we're showing that things are positive and not necessarily extreme. We look at the mid caps, also positive and not extreme, at least yet, getting close to being extreme with the small caps, but still looking more or less positive. And then we do a ratio between the S&P and utilities. Utilities really go hand in hand with interest rates. When the utilities are going down and the S&P is going up, this ratio goes up, and that can be quite positive for the S&P. Lately, we've been chopping more or less sideways here. We want to see this really going up. As we were really going up here, this really was giving some good support to the S&P, and then we've been chopping more or less sideways. If this resumes going up further, we'll see if that gives more support to the S&P 500. So thank you. I hope you found this helpful. I hope you check out some of the other videos that I post. Have a really great weekend, and I will talk to you in the next video.